Back, everyone. Next up, we have Thermal Energy International, supplies energy and carbon emission reduction solutions to some of the world's largest companies. Thermal Energy International is listed on the TSXV under the symbol TMG in Canada and on the OTCQB under the symbol TMEGF in the United States. Presenting today is Thermal Energy International's president and CEO, William Crossland, who is the company's second largest shareholder and has led the company from less than $1 million in revenue to $25 million. Now, Thermal Energy International supplies the energy and carbon emissions reduction solutions. So let's welcome its president and CEO, William Crossland. Welcome, William.
Thank you so much, Anna, and thank you to everyone for taking time out of your busy days to hear the Thermal Energy International story. As Anna mentioned, I've been running the company for quite some time, but I've never been more excited about its future than I am right now. So let's get into it. As Anna said, we're a proven provider of energy and carbon emission reduction solutions to some of the world's largest companies, and that is our strategic focus, those large multinational companies. So just getting into it, we caution you about forward-looking statements. So we believe thermal energy right now represents a compelling investment opportunity. And why do we think that? First of all, we operate in a very large, fast-growing global market with very strong fundamentals. And those the fundamentals of that market have gotten much stronger just in the last 12 to 24 months. And as a result, the business case for energy and carbon emission reduction solutions has never been better, driven mostly by a dramatic increase in the price levels and the volatility of energy and carbon, but also by aggressive new carbon reduction targets from virtually every major company and every major country around the world. But even before the market improved, before these recent market improvements, we had already established ourselves with a proven track record of growth and profitability. So just prior to the pandemic, and talking about the pandemic is getting a little bit old, but there is a story there, and I'm going to explain it. Just prior to the pandemic, so for the 12 months ending February 2020, we had more than 30% compound annual growth rate over 5 years. We entered the pandemic with the 12 months leading up just before the pandemic with $25 million in revenue, $3 million in EBITDA, and about $2 million in net income. What we think right now is a very exciting opportunity and compelling valuation. And the reason is that, after some difficult years right now, for the first 6 months of this fiscal year, our year end is May. And so for the first 6 months of that year, our order intake is 2.5 times our pre-pandemic highs. And it was those pre-pandemic highs in 2019 order intake that drove us to the $25 million in revenue. Our order intake for the first 6 months of this year is 2.5 times that. Projects in paid development with customers, where customers are paying us to develop these projects, is 4 times pre-pandemic levels. So we believe we are poised to continue and exceed our strong track record of growth and profitability. If you believe this as well, it's a very compelling valuation of only about 0.7 times pre-COVID revenues, and even only 1.1 times LTM revenues. So those represent pretty compelling multiples in my mind for a company with this sort of track record and growth opportunity. So to talk a little bit, this is the executive summary, the fast-growing global market. That's really what has been driving the business very recently. So why is the business case for energy and carbon emission reductions never been better? First of all, before I tell you that, I have to point out that unlike residential or commercial, where about 50% of energy use is electricity, in the industrial market where we operate, 90% of the energy used is thermal energy. So almost all of it's thermal, just a small amount is electricity. And that thermal energy is used at about only 50% efficiency on average. So improving thermal energy efficiency is the fastest, cheapest, and easiest and most significant way for our customers to reduce their carbon emissions and energy use. So that's the first thing to set the stage. Second of all, dramatically increased costs of energy and volatility of energy. You can see the charts on the right-hand side. That's the European natural gas prices, North American natural gas prices, and that overwhelmingly is what we are saving our customers, natural gas. You can see the extreme volatility over the last 2 years. You can see the prices got many times higher than the pre-COVID levels. These average prices back out in 2018, 2019, 2020. Those are the periods where you're growing at 30% compounded annually. Prices have come down recently now that the winter is over. But in Europe, they're still 3 times higher than they were back in 2020. North America prices are just a little bit higher than they were back in 2020, but the forecast and the volatility is, the forecast prices are expected to continue going up, and the volatility is expected to continue. Then when it comes to carbon, the carbon pricing model is different in virtually every jurisdiction we're in. But just to give you a couple of examples, the EU carbon market, which is the world's largest, up about 300% the price of carbon since 2021, currently at about $130 Canadian a ton. Canadian taxes, that's our host country, although a lot of what we do is not in Canada. Most of our business is in the United States and Europe. But in Canada, as an example, the current carbon tax is around $65 a ton, expected to go up to $170 a ton by 2030. So these dramatically increased costs and volatility of both carbon and energy has resulted in dramatically improved paybacks for our customers. And then on top of that, as I mentioned, virtually every major company in every major country around the world, just in the last 12 to 24 months, has implemented new aggressive carbon emission reduction targets. Most companies in most countries are targeting a 40 to 75% reduction by 2030, driving to net zero by 2050. So that is a lot of what's driving our business right now, and that's causing the sudden increase in demand from our customers. And this sort of evidences sudden increase in demand from our customers. You can see all indicators are at record levels, surpassing our pre-pandemic highs. So we're finally emerging, better than ever and stronger than ever from the pandemic. You can see total order intake is more than 150% higher than it was back in 2019. Again, the orders we received in 2019 is what drove us to the $25 million in revenue in 2020. Our order backlog is at a record high, 22% higher than it's ever been before back in 2019. And signed project development agreements with customers where they're paying us to develop major carbon emission reduction projects for them is 220% higher than it was pre-pandemic. That's the executive summary. So now to talk a little bit more about thermal energy and who we are and what we do. So what do? We design, engineer, and deliver energy and carbon emission reduction solutions for major multinational companies. That's our focus, major multinational companies. It's a sole source delivery model. We're rarely involved in competitive pitches. What we're providing is unique. And what we're providing provides some development in partnership with the customer. So it's a sole source model, but everything we do is based on our suite of growing technologies down the right-hand side. So the company started out with FluAce. We acquired GEM about 12 years ago. We acquired HeatSponge and Sidekick about 5 years ago. And the ones in blue, we acquired those technologies just a little over a year ago now, a year and a half. Historically, we've delivered our projects and our solutions two ways. So it's a flexible delivery approach. The major way, again, pre-pandemic, about 70% of our revenue was turnkey projects. That's where we do everything for the customer as a single point of responsibility for project development execution. We design, we develop, we install, we commission, we train, we do it all and deliver a project with guaranteed performance. That was the majority of our revenue. The other part of our revenue was custom engineered equipment, where we customize the equipment for their needs. And then we just sell them a piece of equipment. Those tended to be simpler applications and simpler projects where they would just install it themselves. That was about 30% of the business. Okay, so to talk a little bit more about the two delivery models, as you can probably imagine, the turnkey projects are large capital projects that require significant customer collaboration, travel, and on-site work. So they take sort of 2 to 3 years to develop and close and turn into revenue. Along the way, usually what happens is we sign what we call a project development agreement, or a PDA, with the customer. That's basically what we do. Is based on some preliminary analysis, we'll go to the customer and say, look, we think we can save you $1 million and it's going to cost you $2.5 million to do it. Is that something you're interested in? And usually they say, yeah, that sounds like a great return. But we say, but we haven't done the detailed engineering and the detailed development of it. But I'll tell you what, sign a project development agreement with us. And if we don't deliver a project that meets the criteria that we talked about, sort of a 2.5-year payback, you owe us nothing. But if we do, then you either have to pay us or you have to do the project. That's a project development agreement. They're a very strong predictor of a future project. Every project development agreement doesn't result in a project, but many of them do. And then with custom equipment, far less collaboration, travel, or on-site work, as you can probably imagine. They can give us what they're looking for. We can design it maybe with 1 or 2 visits to the site, or maybe none at all. We produce the equipment in 6 months and ship it. As soon as we ship that equipment, we can revenue that order. With turnkey projects, it's a percent complete. So a lot of the revenue isn't done for 6 to 12 months after the order is received. Where do we do it? Establish global reach. So our strategic focus is North America and Europe. We have corporate offices in Canada, the US, and the UK. Those are the yellow pegs on the dot. We have direct sales offices in 7 countries. That's where we have sales, our own salespeople and engineers, feet on the ground. Those are the black pegs. That's in Canada, the US, the United Kingdom, Poland, Germany, France, Italy. But we've delivered projects in hundreds of projects in 30 countries, all the green countries where we have actually delivered projects to over the years. So, while it's not a strategic focus, if we have a customer that has one of our customers has a site they want us to do in an area that's not part of our strategic focus, we will happily do it for them. And despite the pandemic, we did continue to invest in our growth and capabilities and our team. This just gives you a sense of who it is we're dealing with, or at least the type of company. So I mentioned our strategic focus is on very large energy intensive multinational companies. And the reason we do that is strategic in twofold. Number one, it tends to be the very large multinational companies that have very large energy intensive sites. So if you have a site that's using a lot of energy, we can save them a lot of energy and do a nice big project for it. The other reason is these companies tend to have hundreds of sites around the world. So we want to sell more products to more sites. And so a strong potential for recurring revenues, repeat business. Just by way of example, over the last 4 years, about 60% of our orders came from our top 10 key corporate accounts. So far, we've received orders or partially penetrated about 100 of these customer sites in 15 different countries. Now, 100 sites sounds like a lot. Except they've only been, in some cases, we've only sold a small amount to that site, so we're just getting started with that site. But these 10 corporate accounts have 1,000 sites worldwide. So I'd say even with our existing top customers, we're probably less than 5% penetrated. Down along the bottom, you have examples of some recent orders, just to give you a sense of the type of company and the size of the order. Excuse me. You can see by the icons a lot of food and beverage. That's our biggest sector. We do a lot of pharmaceutical, and we do hospitals. You can see that the project values are anywhere, averaging sort of $1.5 to $4 million, $3 or $4 million, typically. Payback sort of 2 to 4 years. Location diversified between North America and Europe. So at the end of the day, what makes us unique? It's really our unique suite of products, our ability to offer a turnkey solution, design, engineer, deliver, install, and train with a compelling return on investment, and the strong established relationships we have with multinational companies, direct relationships. So we sell direct to these major multinational companies, which is unique for a company our size. So at the end of the day, we are the quickest, easiest, and lowest risk way for our customers to get projects done on time, on budget, with guaranteed performance. And that's why about 80% of our business is repeat orders from our existing customers. So to talk a little bit more about the fast-growing global market and give you a sense, we talked about energy and the prices of energy and carbon. It's obvious why energy will increase. Normally the company is buying the solution from us in order to save energy, and they do their payback based on energy. But more and more, the price of carbon is coming into it. So here's 2 examples. And as I mentioned, every country, excuse me. Every country, every state has a slightly different jurisdiction for carbon. But to give 2 examples, one was a European dairy project that we announced about 1.5 years ago. That was a $900,000 project. But in this jurisdiction where this company was, the government gave them $400,000 up front based on how much carbon they were going to save. So that reduced their cost from $900,000 to $500,000. As it was, we were saving about $300,000 on energy. So even without the upfront carbon value, it was about a 3-year payback, pretty good payback. But with the carbon, it went from a 3-year to 1.7-year payback. Second example is a company, a North American cereal producer. This was a $1.4 million project. We were giving them about a 20% carbon emission reduction as a result of this project. They believed that the value of the carbon reductions alone would rise to about $200,000 annually by 2030. So a 7-year payback from the carbon reductions alone. And these are projects that will last essentially as long as the site is in operation. On average, we know that at $100 a ton, that will improve the return on investment for our customers by about 50%. And when you talk about carbon reduction targets, again, it's generally acknowledged the scientific based targets are about a 45% reduction by 2030. That's what we need to do. And more than 3,000 businesses around the world have signed up to those science-based target initiative. PepsiCo, as an example, is targeting 75% by 2030. Colgate Palmolive, 50% by 2030. Pfizer, 60 to 80% by 2050. You can see the government targets as well, the major government targets, and government funding. I mean, governments are coming forward with funding to drive this carbon emission reduction targets. Most of our customers are consumer goods customers, companies. They are openly advertising their carbon reduction targets, so they have to meet it. The same with the politicians, the politics in the government. They have to meet these targets. So what are they doing? They're offering incentives. There's over $10 billion now available from combined governments in the EU and North America for companies to reduce carbon emissions. So that's a positive in the market as well, significant positive. So we're an established company with a proven track record. How do we deliver it? Well, we had a proven growth strategy. We've been executing that over several years. Really has three pillars to that strategy. Number one, leverage our existing high quality customer base. As I said, we want to sell more products to more sites around the world, increase our portfolio of complementary products so we can sell more solutions to more customers and more sites around the world, and then grow our global team and global presence. And we want to do that, and we have been doing that both organically and through accretive acquisition. But you can see most of our growth has been organic. We have done a couple of acquisitions, but most of the growth has been organic. And we believe we have a very compelling acquisition platform. We have an established sales and engineering platforms in North America and Europe, and we have direct relationships with growing list of major multinational companies, and there's still a strong balance sheet and proven capabilities. So that is unique in the sector. So this sort of highlights the results that we've been talking about. You can see going from just under $7 million to almost $25 million in revenue over the 5 years. It then dropped pretty significantly as a result of the pandemic, up to $3 million in EBITDA and up to almost $2 million in net income. But when the pandemic hit, the biggest impact by far was on the turnkey project, as you can imagine. These are big projects that customers are doing, required a lot of site presence by non-essential personnel. So the first thing a lot of these companies did back in 2020, when the pandemic was declared, is they shut down their sites. They ordered all non-essential workers off site. There was travel restrictions. We couldn't get to site. So the whole turnkey business ground to a halt. The good news is, after a couple of months of a dip, the custom equipment business took off again and continued to grow. So it's grown right through the pandemic. And despite the pandemic, despite the significant drop in turnkey business, which at that time was 70% of our revenue, for most of the pandemic, we maintained our profitability. We continued to invest in the growth, invest in the team and training, acquisitions and architecture for growth. We believed strongly that the market was going to come back stronger than ever. Quite frankly, we maybe didn't think it was going to take 3 years, but we knew it was going to come back and it was going to be stronger than ever. We wanted to be ready to hit the ground running when the time came. So we kept the team and continued investing in growth as best we could during the pandemic. The more recent results, the more recent losses, really as a result of about 1.5 years ago, we sort of saw the light at the end of the tunnel and we started spending more for growth, as well as some government programs went away. So though the losses were anticipated, we knew they were going to happen. They were strategic. We knew it's something we had to do to ensure we were ready to hit the ground running when the market returned. For the first half of this year, the results, I will say the recovery has begun and the growth is resuming. So revenue hasn't caught up yet. The orders have, but the revenue hasn't, based on how long it takes to turn orders into revenue. The revenue for the first 6 months of this year was down about 9%, but custom equipment continues to grow. It's up another 20% this year. It's now more than 30% higher than the pre-pandemic levels. But the turnkey projects is still lower, even though the orders are higher. The revenue hasn't come in yet. As a result of the long sales and revenue cycle. EBITDA was a bit better than last year, so turning the corner and starting to get better, and we maintain our strong cash position and working capital. The exciting part, as I mentioned, is the orders intake so far this year. So almost triple last year, 152% higher than fiscal 2019. And for the first time since 2019, these are record levels for both custom equipment and turnkey projects. That's exciting. And even more exciting is the record project development agreements with customers. 16 project development agreements received in the last 12 months, 60% higher than last year, 300% higher than pre-pandemic levels. So the outlook, we believe we're poised to continue and exceed our strong track record of growth and profitability. To give you a little bit more detail on that, you can see the next couple slides sort of highlight the order intake in the different, both custom equipment and turnkey. So in custom equipment, you can see we're up 300% since 2019. So very strong this year. Custom equipment revenue is earned on average 3 to 6 months after order receipt. Turnkey projects, again, 450% higher than last year, 65% growth since 2019. So a record for the first 6 months of the year. But projects delivered and revenues earned over approximately 6 to 12 months after order receipt. So it takes a while for that to hit the top line and the bottom line. And then looking even further forward is the PDAs. You can see the significant growth in project development agreements that we've signed with our customers. That's a strong precursor to an indicator of future orders. Not every time, but on average, we get a heat recovery order, a turnkey project order about 12 months after the PDA. And then finally, this is the top line, 152% total growth. So you can see we're this year, for the first 6 months, well ahead of any other prior period. So to sum up, our LTM, our last 12-month order intake is now ahead of the highest 12 months we ever had. Again, this $22.7 million in 2019 drove us to the $25 million in revenue. So we're now at 23 million. Order intake, order backlog is 22% higher, and project development agreements signed 220% higher. So summary, quite frankly, 6-month year-to-date order intake well ahead. Project development agreements well ahead. We're poised to continue and exceed our growth, and we have a very compelling, right now, valuation multiple. You can see recent price is about 10 cents. That's a market cap of about $16 million. With net debt, that brings the enterprise value up to 17. So enterprise to pre-pandemic revenues about 0.7 times. Enterprise to EBITDA about 6 times, and a PE multiple of only 10. Again, pretty nice multiples from my standpoint for a company with this sort of growth profile. 164 million shares outstanding, fully diluted shares 182. Though all the options outstanding, there's no broker warrants or anything like that. All the options that are outstanding are employee options for our staff. I own about 4% of the company. All of that has been purchased on the open market. The founders of these technologies are long gone. Most of these technologies were developed back in the 90s. And it's just now that they're getting attention because of their energy and carbon emission reduction capabilities. So management directors have about 10%, but almost all of that has been purchased in the open market using their own funds. So that's, shows you the faith that we have in the company. So at the end of the day, why invest now? The business case for energy and carbon emission reduction solutions never been better. We're an established company with a proven track record of growth and profitability. We believe we're poised to continue and exceed our strong track record of growth and profitability. And we have a compelling valuation and investment opportunity right now because the current valuation does not reflect the significant recent market improvements, our proven track record, or the current record order intake levels. Thank you so much. And now, Anna, I would be happy to answer any questions.
Great job, William. We do have some questions for you. So is there any seasonality or cyclicality to the business?
There isn't really any cyclicality at all. I mean, first of all, because we tend to, I used to joke with people, beer and chips and food, that was growing during the pandemic. So there's no cyclicality because the industries we tend to service, food and beverage, pharmaceutical, hospitals, are not cyclical. There is a little bit of seasonality we notice in order intake, not in terms of revenue or results, but in terms of order intake, we tend to see a fair bit at the start of the year and the end of the year. The start of the year, because that's the beginning of many companies' capital budgets. The end of the year, because they may have some money left over. So there's a little bit of seasonality to the order, but no cyclicality. And
so what industry makes the best customers?
Well, when you think about it, a lot of what we do, energy efficiency, most of what we're doing is we're saving them thermal energy, which is heat energy. So it's any industry that uses a lot of heat. That's the first part. but then we also have to find industries that need a lot of heat, have a use for that waste heat, because a lot of what we do is capturing waste heat. So when we go to a site, we often find lots of waste heat, like they're losing heat everywhere, but they don't always have a use for that. So where we find where they really have a need for it is places that need a lot of, hot water or heating, and that's food like that's companies like food and beverage, because they have cooking, they have sterilization, they have cleaning. Same with pharmaceutical, same with hospitals. Hospitals use a lot of hot water. So it's anywhere where they're using a lot of heat and have a need for a lot of hot water.
And talk a little bit about your delivery time after an order is placed.
Yeah, so that's a complicated one. So as I mentioned, our business, we have a flexible delivery approach. It's both turnkey projects and custom equipment. The custom equipment, once we get the order, as soon as we ship that piece of equipment, we can book the revenues. That's usually about 3 to 6 months after we get the order. On the turnkey projects, it's done based on a percent complete. So every quarter we have to say if this is a $3 million project, what percent of the project is complete? And that percent complete is determined by the percent of costs of the project that you've incurred. Most of the costs are rear end loaded. So a lot of the upfront is more engineering and ordering the equipment. So most of that revenue from turnkey project doesn't come at least for 6 months after the order is received. So it's sort of 6 to 12 months. So for custom equipment, 3 to 6 months, turnkey projects, 6 to 12 months. And
so talk about the biggest challenge in growing this business.
Yeah, I would say there's two challenges. Number one, it's people. We're a technology company, right? So we're basically, engineers and salespeople, and most of our salespeople are engineers and a few administrative people. So it's finding good technical engineers, good technical salespeople. We hire most of our people right out of school and train them because what we do is unique. So it's very hard and impossible to find someone that sort of knows exactly what it is we do and how to do it. So it's getting good people and then training them. That's a fairly long cycle. We have to continue doing that. Finding good people and training our people to keep them at the top of their ability. And the second thing is scaling the business. The real advantage that we provide, the competitive advantage that we provide, is the customized nature of everything we do. So we go to a site, we find out what they need, where the heat sources are, where the heat sinks are, and we put a package together. So everything we do is customized. So the way we scale that is with our corporate accounts. So once we've convinced a customer to do it, they might have 5 other plants that are very similar. So there's a much lower sales cycle for, after the first one to do the next one, the next one, the next one. So it's selling multiple sites from the same customer. As an example, in the fall, one of our products is called the GEM Steam Trap. We sold retrofitted 26 different sites. We got an order for 26 different sites of a major multinational to redo their GEM steam traps at 20 different sites all at once. That's the goal, to replicate the orders across our customer sites. And
so talk about your client engagements. Are they largely bespoke in nature?
They are. So everything we do is bespoke, is customized, because every site is a little bit different. And you might have 2 sites from a given company that are producing the same thing, but they might have a different energy cost. The site layout will be slightly differently. So everything we do is bespoke, not just for the customer, but for that customer's site. And every site is a little bit different.
Duncan McDonald wants to know, when will thermal energy start to show sustainable profits?
Well, we're very careful not to give forward-looking information. But we've said our order intake is back to where is ahead of where it was previously when we were profitable. So I'm feeling pretty positive about the next 12 months. We also explained how when we get an order, it takes a big turnkey project order. It takes 6 to 12 months to revenue it. So you have to take that into account as well.
Jill Salazar congratulates you on your growth and asks, how are you getting your customers and how are you growing revenue? Yeah, so growing revenue is we know, we've been in it for a while. We know the type of sites that need our business, that can use us. It's food and beverage. So we get our customers mostly by, sort of knocking on their door. But we've been in the business long enough now that we've got 100 different multinational companies probably that we have sold a little bit to. Our focus over the next few years is going to be selling more to those companies that know us. So it's really doing more with that existing extensive client base that we've already got. And Vanessa Collins says, with all this good news, why do you think the share price has been languishing?
Yeah, I think it's because we're really just sort of ramping up our investor relations. We did put it on hold during the pandemic because we were saving money, right? We didn't want to reduce our team. So all discretionary expenses were put on hold, and we wanted to wait till we knew that things had turned around and we were going to turn the corner. And that's really what's happening now. So, I'm hoping that the share price won't be languishing much longer because we're going to be much more active on the investor relations front, telling the story as we are today.
And one last question due to time. Al Johnson asks, says, with credit conditions tightening and interest rates rising significantly, do you foresee any issues with the rolling over of your debt or your ability to further borrow to fund your growth?
No, neither. We don't need to. I mean, we have some COVID-related debt that we got, and the rest of the debt was for an acquisition. We don't need debt to grow organically. I mean, when we grew, we've grown from $1 million. Anna, you mentioned I've been with the company from under $1 million to $25 million in revenue. That was all done with our own cash flow. When we're hitting our stride and profitable, we generate a lot of positive cash flow. We have very little manufacturing site. We're mostly a virtual manufacturer. And our projects are done on a cash flow basis, so there's not a lot of working capital. So we can grow organically with our own cash flow, usually quite well.
Wonderful. Well, we are out of time, but we have lots more questions for you. So we're going to send them to you, William, so you can answer on your own. But we'd love for you to come back and give us some updates in the near future.
Thanks so much, Anna. It was a pleasure.
It was a pleasure on our end as well. Okay, thank you. And everyone stay with us. We'll be right back with our next presenter.